During economic crisis, making clear decisions becomes harder because pressure changes how people think. As uncertainty rises, risks feel heavier, judgment narrows, and markets start reacting less to hard data and more to stories, expectations, and fear. The human mind isn't comfortable with ambiguity, so in unstable conditions, it looks for quick shortcuts. While those shortcuts help in everyday life, in financial markets, they often lead to costly mistakes. In uncertain environments, people look for clear answers and simple forecasts, or a single sentence that seems to explain everything, like the dollar will rise or the market is turning. But during crisis, many forces move at the same time and conditions keep changing, which makes simple explanations unreliable. As the need for certainty grows, people turn to rumors and confident-sounding opinions, and that usually pulls them away from clear judgment. In uncertain situations, people start using the actions of others as information. When the future feels unclear, behavior itself becomes a signal, and instead of thinking independently, many people look around to see what everyone else is doing. The problem is that this happens all at once. Everyone ends up watching everyone else, which amplifies market moves, creates short-lived extremes, and often leads to sudden reversals. By the time a decision feels comfortable, because it seems widely accepted, risk is already building beneath the surface. As volatility rises, fear follows, and fast price movements create a strong sense of danger. In response, the mind pushes for action, even when action isn't the real issue. In crisis, risk is closely tied to liquidity, drawdown tolerance, and how much flexibility remains if conditions continue to worsen. These periods tend to remove structurally fragile participants, where weak positioning and poor liquidity cause far more damage than being wrong on analysis. Fear slows people down, and when it's time to enter, while hope keeps them in positions longer than they should stay. As pressure builds on both sides, decisions become more extreme, and over time, this is how people repeatedly end up buying near highs and selling near lows without fully realizing what's happening. One reality that often gets overlooked in every crisis is how instability shortens time horizons. As pressure rises, focus moves away from strategy and towards reaction, from planning ahead to watching every small move. In these conditions, markets tend to push capital away from reactive behavior. What truly makes a difference during crisis is the structure behind decisions and having a clear framework that helps limit damage as conditions keep changing. So take a moment and ask yourself this: when pressure builds, which pattern shows up first for you? Is it the need for certainty, the pull of the crowd, or making rush decisions just to feel some relief?